I was looking into Apple earlier today, and more specifically, I was reading this article from one of the Simply Wall Street analysts about how the current share price is trading a bit ahead of forecasts. And it goes into how the company is currently trading at a multiple of like 30 or just under 30 times earnings. But the analysts don't actually expect the company to have that much earnings growth in the future. So I wanted to look into the company's financial health because I know that the stock the company has been performing a lot of buybacks since like 2012 or 2013. And so I want to look at the company's financial health and kind of see how it's been trending and how the company's been utilizing debt and equity in its capital structure, and how it's been returning capital to shareholders. So I recorded that video earlier today, and we'll play that now. Hey everyone, in this video we're going to have a look at Apple and more specifically its financial health section on the Simply Wall Street Company report. Now I'm going to go through this part of the report and share with you the insights that I'm gaining as I read it, and also some supplementary data or complementary data that can help give me some more context to the insights that I'm finding. So the first section we're going to have a look at here is the financial position analysis, and basically there's two checks that Simply Wall Street checks here, and the first one is whether or not the short-term assets cover the short-term liabilities, and the second one is whether the short-term assets cover the long-term liabilities. Now, I'll do a bit of an explanation to add some context. So, short-term assets is stuff like cash and cash equivalents. Short-term liabilities is any sort of bill that's due to be paid within the next 12 months, like accounts payable or rent due within the next 12 months. And long-term liabilities is any liability that's due to be paid in greater than 12 months' time, right? So, it's longer-term liabilities. And this can also be stuff like rental payments in terms of like if it's a multi-year rental lease agreement and stuff like that. So I thought I'd give some context by actually showing you an example on the company's 10K. So we can see here leases is one of their obligations, and it says the company has lease arrangements for certain equipment and facilities, including retail, corporate, manufacturing, and data center spaces. As of September 25th, 2021, the company had fixed lease payment obligations of $14.6 billion with $1.8 billion payable within 12 months, right? So that $1.8 billion payable within 12 months contributes to this short-term liabilities, right? And the remainder being the remainder of the 14.6 adds up to is included in the longer term liabilities because those are not due to be paid within 12 months. So why do we check short-term assets against long-term liabilities? Well, we just basically want to see if the company does have enough cash and cash equivalents, like liquid assets, to be able to pay any obligations that are due. And in terms of the short-term ones, yes, Apple does have enough cash and cash equivalents on hand to pay these liabilities when they come due. As for the long-term liabilities, it seems like that isn't the case. It's got $162 billion in terms of these longer-term liabilities, but only has $134 billion in cash and cash equivalents. So that is an issue in this quick check where it's like, okay, how can I pay off the liabilities? Well, with cash, do I have enough cash as it stands right now? No, I don't. So one thing to get context with that is like look at the future growth section, the past performance section, to see if the company is generating lots of cash flow. If it is and generating excess cash flow and able to like retain earnings, then that can help add up to its cash balance and help it pay off these liabilities as they come due. Because these could be multi-year agreements, and some actually, I believe, have liabilities out to like 10 years or so. So there is a long time frame for when those liabilities become due, and it's worth looking at the company's cash flow generation ability to see if it will be increasing its cash balance to pay these off when they do become due. So another thing to keep in mind is that why don't we check long-term assets against long-term liabilities? Well, that's simply because these aren't liquid, right? Like this is like property, plant and equipment and other illiquid assets that would take longer than 12 months to kind of liquidate. So to be able to try and pay off these liabilities, you wouldn't want to be like, oh, okay, this debt is coming due, let's go sell that building. Like, it just doesn't really work like that. I mean, it can in a worst case scenario when you're trying to liquidate all your assets, but in a general, like, sensible running of a business, you wouldn't want to sell these valuable physical assets and stuff that you have to try and pay off these liabilities. You want to use cash instead. So that's why we don't check long-term assets against long-term liabilities. Now, the next section I want to have a look at is the debt to equity history and analysis. And this section here just basically shows us how the company has been utilizing debt and equity in its capital structure, right? So debt and equity are used to finance a business, right? Like debt being borrowings and equity being like investments from shareholders. And we want to see how that's been trending over time, right? And there's a few interesting takeaways here. So one is that Apple actually has a reducing equity balance from the last couple of years. It's actually been reducing from like 140 billion to 63 billion, and I'll try and help explain explain why in just a second. The company's debt, on the other hand, has actually been increasing from 44 billion to 124 billion. So it's really leveraged up a bit. Now, there's a few reasons why this has occurred, right? First of all, interest rates have been so low, and Apple is such a profitable business that it has decided to take on debt because it can because it can easily afford the debt. And we'll find that out in a metric in just a second. And so utilizing more debt in its capital structure makes more sense because it's so cheap, right? And now for the reason for the equity actually being reducing over time is quite interesting. So you may think, oh, it's bad to see that because shareholder equity is basically the ownership that shareholders have in the business, right? And as debt has been increasing, you would expect, and the value of the company has been increasing as well, you would actually expect that the equity would be improving. But one thing that's important here to know is that Apple actually has a buyback program, and its retained earnings have been decreasing quite a bit. So this article here will help us explain it. So Apple has been buying back shares since late 2012, right? And since then, it has spent over $400 billion repurchasing stock. Now, if you adjust for stock splits, Apple has actually decreased its share count from 26 billion to about 17 billion, which is a decrease of like 35%. So if you're a shareholder since 2012, your ownership has actually increased. And if you've held onto your shares, your ownership has actually increased as Apple has reduced the amount of slices in the whole pie. And so these buybacks here are basically funded by the free cash flow generated from the business and its retained earnings. And Apple has had quite a large balance of retained earnings back in 2012. And since then, we've seen it reduce quite a bit, right? So here we have one of the 10K filings, and this is from 2017, just to give you an example of what's happened with the retained earnings and why the equity we've seen has reduced. So you can see here, this is the balance sheet, and here we have the shareholders' equity. Now, this line here is the retained earnings, $98 billion. This is the retained earnings that have occurred, basically any leftover net income that the company's had from like its inception date. So it's accumulated and retained $98 billion worth of earnings. Now this is 2017, and you can kind of see this is where this starts, right? 2017, 134 billion, this to give us that total equity balance there of 134 billion. So now what does that equity actually look like? Well, if you look at the same thing, this is 2021, the 10K just released in September, that same retained earnings is actually $5 billion now. So it's decreased quite a bit, and now total shareholders' equity is about $63 billion, which is exactly what we saw here in the chart, right? So the fact that the company's retained earnings has reduced so much is what has driven the company's equity down. And now that is because they've been returning so much of that capital to shareholders in the form of buybacks and dividends. Like we saw, $400 billion in the form of buybacks, funded by both free cash flow and equity, and dividends paid as well. This article also talks about dividends, and you can see it here. So the company has spent so just billions of dollars on dividends, right? Like primarily it's been spending a lot of money on buybacks, as we saw, but we can see it's been spending at least about $10 billion per year since 2013 on dividends. So it's been quite a lot. And now back to this chart, we can see that it's like, okay, the company's been utilizing more debt because it's affordable, and the company's equity has been decreasing thanks to it basically using up that retained earnings balance, and returning that money to shareholders since the 2012, right? Now, these are the checks that Simply Wall Street does. We can see here that the net debt to equity ratio is actually quite high, right? So this includes cash, and it's actually at 98%. Anything above 40% is considered pretty high. And we can see that Apple is actually utilizing quite a bit of debt in its capital structure. But given the debt is so cheap, as in like only a couple percentage points to finance, it's quite affordable as it is right now because Apple is quite a profitable business, and these next checks will help confirm that. So the next check, though, is it doesn't pass either, and that's because its debt-to-equity ratio has increased from 67% to 197% over the past 5 years. Now, this check here doesn't include debt, right? So we can see the red line is basically almost double what the blue line there is, 124 billion versus 63 billion. The next check is basically all about the financial affordability of the debt. And so how well is it covered by the company's operating cash flow? And this is the cash flow generated from the core business. And we can see that it's covered quite well, right? Apple generates enough cash flow from 1 year to cover 83% of the debt. So if we look at past performance here, we can see cash flow from operations is $104 billion, right? Like that's quite a lot. And in terms of the financial health here, we can see that $104 billion is obviously 83% of the total debt. The next check is in regards to the interest coverage. So Apple actually earns more interest than it pays, so its interest payments are not a concern. Basically, it has a whole bunch of cash and different investments in terms of where it holds its cash, and it's actually generating more interest on its cash balances than it has to pay on its debt. So in that regard, the interest coverage is not even an issue, because if it really wanted to, it could use the interest that it's generating from its cash and other loans and stuff like and other asset balances and stuff like that to pay off the interest that's due on these pieces of debt. So that's a very affordable situation. We can see here that confirms the idea that the debt is very, very affordable, and Apple can easily finance continuing to run that kind of leverage. Now, the last check here is just basically see a breakdown of the balance sheet. And this just gives us an idea of like kind of all the assets, right? Because assets has to equal liabilities plus equity. And it just gives us a breakdown of all the specifics, right? So the main thing I would look out for here for a company like Apple is kind of just to see if there's any sort of red flags. Now, obviously we know there's the debt, but red flags like, okay, let's see receivables. Receivables is what it's due to be paid, right? So it's like it's due to be paid $51 billion from products that it's already sold, and its accounts payable is $54 billion. So this is like people it has to pay, like suppliers and other people like that. So it's got $54 billion to pay, $51 billion to receive. That isn't a huge discrepancy, so that's not too concerning. And then other stuff like this, we can see physical assets being buildings and property, plant, and equipment and stuff like that. Longer term assets, these could be like intellectual property and goodwill and other things like that. Cash and short term equivalents, $62 billion as we saw. Inventory can obviously just be like the hardware and stuff that it sells, being iPhones and Macs and all that. And this just gives us a full breakdown of all of this. So nothing too crazy stands out there, but that is just how you can kind of review this. Now, the next steps would obviously be to look more into Apple, or if you don't like this particular balance sheet that you're looking at and you're like, no, I don't really think it's as pristine as I would like, as in like say you're looking for a company with no debt, we could look at next steps and basically have a look at more companies in the tech industry that have a healthy balance sheet. Alternatively, if you want to stay on Apple, you can actually do more research by reading through the whole company report and trying to get some context, right? Have a look at the company's past performance, see how well it's performing there and how well it's grown over time. Have a look at the company's future growth, have a look at how well it's expected to do in the future, and if this like interest repayments and debt repayments in the future might become an issue if cash from operations or free cash flow are expected to reduce in the future. Those are the kind of things you can look into to get some more context, but in this video I just wanted to focus on the financial health section and kind of shed some light on how Apple has actually utilized debt and equity in its capital structure, and how the buybacks have actually had quite an influence on the company's declining equity balance. So I hope that's been helpful. Thank you so much for watching. I'll see you next time.